Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:16 a.m. Central Time, and I'm recording this in preparation for the market day, January the 28th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive right in. In overnight action, we had some initial weakness in the broad market indices on the futures markets, but they have recovered nicely. Obviously, NASDAQ with the big news on Apple, it started up and stayed quite strong really all night. ES was more the weakness than the strength. It has recovered very nicely and is now up in the overnight action. Only the Dow is really at scratch. In our commodity side, crude oil, another big hit, down 1.45%. Other than that, the other futures markets that we follow, the euro, bonds, and gold, all really essentially flat at the time of this cut. In overseas action, China, again, big action, down 1.41%. And the other markets all pretty much around scratch. Nothing really of significance there leading into our day. And macroeconomic reports for today, big day. This is FOMC day, so expect that you could have some initial action this morning. Likely, if we go to form, goes relatively flat at some point later in the morning into the FOMC announcement, and then the fireworks begin. You also have crude oil inventories today, so if you're a crude oil trader, you must be aware of that. That will rip your face off in the short-term trading. So a couple big macroeconomic reports for today. In terms of tomorrow, got the typical Thursday unemployment claims and then pending home sales, and I think that's about it of anything of significance for U.S. Market traders. In terms of current volatility conditions, things of note. Obviously, yesterday was pretty weak day. Obviously, we saw a lot of weakness in NASDAQ as Microsoft had a big miss, and Microsoft is a very, very large player and had a significant impact on that market. Likely, we'll see a lot of that retraced today with the action from Apple if that continues to follow through. But we had a 3 standard deviation day yesterday in the NASDAQ, 2 standard deviation day in the Dow, and the S&P shows 1 standard deviation. This was nearly 2 standard deviations yesterday. The Russell, though, has been showing quite a bit of bullish action in recent trading days, so we'll take note of that. We'll continue to watch also for the action of the financials and the NASDAQ to see if we can see some growth and bull market tendencies coming out of those markets. In terms of our regular daily report, nothing really new today. This will be a fairly simple broadcast today. Still phase 3 in our trend opinion. Higher highs and higher lows are what is expected. We have had some new risk elements come into play, and I'll get into that in just a moment. But our active trader market posture is still okay to put on new short-term and intermediate-term bullish trades. We are in a confirmed uptrend. Position sizing, the models call for, in both cases, up to 100% position sizing. I need to change this. 1-day outlook is actually bullish. 3-day outlook is also bullish, and our 2-week outlook is slightly bullish. On our market forecast opinion, 3 of the 4 indices were bullish. The NASDAQ had dropped, the bear had dropped, the Dow had dropped to bearish. So that was the outlier. It is still over 50, but the angle of our intermediate term line is now down. So the Dow had turned into a bearish market forecast opinion. On our hedge warning levels, we are still at a level 0, normal in a confirmed uptrend. We did have some warning levels pop. We do have a market in decline and a sharp increase warning, both fired on our volatility based indicators. So a couple things on the volatility based area, and then in the key intermarket risk aversion indicators, this is something new that I've added. 5 key intermarket indicators that can help us measure the condition of the market in terms of risk aversion or risk on. And we do have risk aversion with 3 of those 5 indicators, so slightly elevated risk there. So all in all, though, this still comes together into a threshold level 0. We will watch this. If we continue to see an uptick in the number of warnings, we may take that to a 0 plus. We're nowhere really near level 1, though, at this time, based on the information that we have this morning. Option income strategies, the VIX is still within the acceptable volatility window and conducive to option income strategies. And other things of note for this morning. You'll notice that in recent days that the sector-specific market posture has really been quite rapid to change. And you might ask, how can you go from green, green, green to neutral, 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 so quickly on a sector across 3 different time frames: short, intermediate, and long? Well, keep in mind that really there's a relatively flat series of lines that are coming across these different market posture time frames, and as such, as we flip-flop around that flat line, it quickly changes the appearance of the posture. The bottom line to this is that the entire market is been pretty much in a sideways range with similar highs and similar lows. This is reflected also in our market posture indicators, and as such can quickly appear to flip to be stronger than perhaps it really is, or weaker than perhaps it really is. We really are in a very, very, very neutral kind of market condition right now, and this is going to be reflected across multiple indicators. So this is probably not as valuable as it is during most market conditions while we are flatlined across so many of these sectors. In terms of sector percent change, a better day yesterday. Obviously, energy, we know from the overnight, is well down, but here yesterday energy was well up. So a lot of volatility still within the energy sector, but others, consumer discretionary. You look at this. This is your risk on, was doing well yesterday. High beta groups of energy, consumer discretionary, materials, and financials all doing relatively the best yesterday. And then some of the risk off staples, utilities, healthcare, relatively further down the list. But the most consistent performances of late have been with our more conservative sectors, the utilities, healthcare, consumer staples specifically. So we'll continue to watch how that fleshes out. In terms of industry groups, our top: retail, railroads, transportation, internet, healthcare, and biotech, rounding out the top half dozen industry groups. As always, greatly appreciate your liking us. You're watching us on YouTube. If you will like us on YouTube, that is most appreciated. Obviously, like us on Facebook, and follow us and provide commentary on our Facebook page. Anything that you would like to comment on is always appreciated. It makes a difference to helping us spread the word, the work that we're doing here. And if you've enjoyed this, your friends may also enjoy this, and it is most appreciated. As always, of course, you can get your questions in to support at falconglobaltraders.com. More information at falconglobaltraders.com, the webpage, including information about our 2-week free trials. Disclaimers: hit the pause button if you need more time to review. And then, as always, we thank you for your contributions and participation with the Falcon Global Trading community. Good trading, and goodbye.